Geof Smith, and he's been trading for over 20 years and was instrumental in developing the DTI method. These Platinum Experience core level classes that DTI offers took first place in SFO Magazine and Trader Planet Star Awards in the best trading courses category. So I can imagine we're gonna get some pretty great education from Geof today. He's gonna be talking about one of my favorite topics, all that glitters is gold, and the characteristics, benefits, and risks of trading gold. Learn how gold moves and what its key numbers are and where to buy and sell gold commodities and stocks. So with that, we want to welcome Geof. Hey, Geof.
Hey,
howdy,
Geof.
how are you?
He's all set. He's a pro. He's got he's unmiked. He's
ready to rock and roll.
Ready to rock and roll.
Hey, Geof.
Don't miss Jeanette.
Jeanette, how are you?
Give me a hug. I miss you.
Big hug. How are
I
you?
love you. Are you in Mobile?
I am in Mobile.
You're like right around the corner. Why am I virtual hugging you? I just need to get in my car and come over there.
Come on.
All right, y'all go ahead. I was on the phone and I saw Geoff's face. I was like, I got a mic up. I love you. Good luck.
Okay, thanks.
All right. Well, if you're all set to grab the screen, Geof, we're going to let you just take it away.
And there it is, right? Yep.
Yep, we see you perfectly, buddy.
You see my PowerPoint?
Yes, sir.
Awesome. All righty, let's talk gold. And I guess we'll make Nikki happy here. So a little bit, I'm going to go through some basic stuff first. So if you've already seen this, cool. If you have not, well, I guess we'll learn a little bit here. I want to kind of put everybody on the same playing field. So I'm going to go through a little basic education of stuff, and we'll get into talking about charting gold, and we'll talk about key numbers in gold and how I look to trade gold and stuff like that on a shorter term basis. We can also look at a longer term basis if we have time, but we'll kind of go from there. Of course, there is risk in trading. Past performance not indicative of future results. And if you can't afford the loss, don't take the trade. And I'm an engineer, so I'm not the best typist in the world, so beware about that. I do make mistakes. So a little about myself. I've been trading in the markets a little over 30 years. And I was originally a pipeline engineer for about 10 years, but during that time was waking up around 3 o'clock in the morning and trading the S&P futures up until that 6:30 in the morning. Then I'd go to work all day and then come back and be with the family in the evening time and then do it all over again. That was throughout the 90s. And in 2000, a gentleman named Tom Busby had started a school here in Mobile, Alabama, and he asked me to help him out. So I moved out of the panhandle of Texas to here, and I have been teaching and trading ever since. I'm traded in just about every market out there, not every vehicle by any means, but I'm more of a commodity trader than anything else. I do like trading equity and equity options and stuff like that, but the commodities have always just kind of, I don't know, intrigued me just because it's stuff that we use every day. And I mean, think about corn and wheat and soybeans and live cattle, lean hogs, sugar, cotton, coffee, whatever it may be. It's just stuff that we normally have around in the house and everywhere else. So, or on us. And so I've always just kind of been intrigued just to kind of watch those prices move around just to see if things are more expensive or not. Just kind of like the lumber right now. Lumber's going through the roof. So if you're going out to Home Depot or Lowe's to buy lumber, it's going to be very expensive just because, well, lumber's really high right now. They just had a hard time getting lumber out of the mills to all the stores and stuff. Plus, there's a huge demand from builders. It's about a 2-month lead time right now. So, but anyway, let's get away from that. What I want to talk about, first of all, I'm going to go through the contracts and stuff, talk about some ETFs and some stocks that go along with gold and silver, even copper or whatever you want to look at. And then what kind of drives gold and silver around. Of course, we're going to get into charting them, key numbers, and then kind of how to trade it. So kind of got a path to go along through here. So let's kind of get started. First of all, and this is kind of the stuff, if you don't know, you'll learn something. If you've already got this down, don't worry about it. But gold futures are traded at the CME. They call it the COMEX, but the CME owns it, so whatever. It's Symbol is GC. Some platforms put a G in front of it for Globex. So it's CGC, whichever, but that's the symbol. The months that it trades are February, April, June, August, and December. Right now, we're on the December contract. It's worth $100 per point. It trades in 10-cent increments, so it's worth $10 per tick. It controls 100 troy ounces, and it is deliverable. The first notice date, that's what that FND means down there, is the last business day of the month prior to the month of expiration. So if you're long on first notice date, you will be assigned gold. So you want to be out before first notice date. Don't worry about last trade date unless you're short. If you're short, they're not going to deliver to you. You have the right to deliver if you're short. So you can hold that past first notice. But if you're long, you can be delivered. So beware about that. There is a micro contract on gold if that's a little more too expensive. Everything is traded at the CME and everything like that. Its symbol has an M in front of it for micro. So it's MGC or MGCG. Same trading months. It's worth 1/10 of the big contract. So every point is $10 and every tick, since there's 10 ticks, is $1. Trades in 10-cent increments, and it controls 10 troy ounces of gold. It's deliverable also. So make sure you're out before first notice date or you'll get 10 ounces of gold. So now silver, it's SI or GSI traded at the CME. The months are, I guess, between the gold months is the best way of putting it, except for the December contract. So where there's a February gold contract, there's a January silver contract. And it goes March, July, September, and it kind of skips and goes straight to December after that. This contract is kind of hefty. It's worth $5,000 for every dollar moved. It's $25 per tick. It trades in half-cent increments, controls 5,000 troy ounces of silver, and of course, its first notice date is just like gold. It's the last business day of the month prior to its month of expiration. But since it's 1 month off of gold, it does it at a different time. So there's a micro on it. It's SIL. There's also a stock SIL, so beware of that. But there's SIL or GSIL. It goes January, March, July, September, December, just like the big contract. It's worth $1,000 for every dollar moved, or $5 per tick. And it controls 1,000 troy ounces. So that's the gold and the silver contracts. A lot of people are trading the micros now just because margins are so high on the other ones. The margins aren't so bad when it comes to the micro gold or the micro silver. So that's why I kind of put them in there a little bit. Some ETFs and stocks that I like looking at and trading. I'll put them that way just because there's a lot more than this. But there's GLD, which is the gold ETF. There's GDXJ, which is the Junior Gold Miners Index. So there's also GDX if you want to look at it. Newmont, gold is Barrick, and then of course KGC is Kinross Gold. But these are the ones I like watching and trading along with the gold market, and just because you can grab dividends and stuff like that off of those where you can't really on the futures. On silver, we got the SLV, which is kind of like GLD. It's the silver ETF. We got SIL, which is silver miners ETF. And that's what I was telling you. SIL in the futures and SIL is still silver, but this is more of an ETF stock thing. Wheaton Precious Metals, that used to be Silver Wheaton, I think is what it used to be, but they changed their name and stuff like that. Pan American Silver, Mag Silver, and First Majestic are the other ones that I kind of like looking at as far as the silver goes. So what drives gold? There's a lot of things that drive gold. Of course, the movement of the US dollar, investment demand, gold production, and wealth protection. Another thing that right now is really driving gold, I'll kind of blame it on COVID-19 for one, but the Fed has put out a huge amount of money, basically liquidating the dollar. If you've seen the dollar lately, it's been declining pretty hefty. So you've seen gold kind of pushing up. The problem is gold's gone up so far so fast. It wouldn't surprise me if we don't get some correction going on in here. Probably test the 1900 and even down to 1800 possibly if it does kind of start really pulling back. But right now it's holding above 1900 really well. But we've had a lot of Fed comments that have been kind of pushing gold higher. Now that they've actually come out and said they want to let inflation run a little bit, gold is a good inflation hedge. So, but when there's fear in the markets, you'll see gold go up just because people run to something safe havenish. But when the markets are really comfortable and everybody's comfortable, you'll see gold kind of pull back a little bit. So, but that's kind of what drives the price of gold around. Silver's a little different. It doesn't really care about the dollar all that much, but it'll move along with gold a lot of times. Silver has a tendency to outperform gold in its moves. If you've seen gold here lately, it took off from 1700, ran to 2000. Well, silver was down at 16 bucks and it ran to 30. So it went up almost 100%, where gold went up somewhere. In fact, on the year, I think gold's up around 28%. Silver's up 50% on the year. So, or 58%, I guess. But that's the thing, when we start looking at how they move together, usually silver will outperform gold. Of course, investment demand does that. Silver production, big thing of silver, it's more of an industrial metal. So technology uses it a lot. And of course, you'll see it in jewelry and everything like that, just like you will in gold. But silver is kind of they call it the poor man's metal just because it's a whole lot cheaper than gold is. But it can move around a whole lot more. So just beware of that. But anyway, when I start looking at charting gold, and we'll kind of slow down a little bit here and kind of go through some things. I like starting out with looking at a weekly chart. And the reason for that is I want to see what the big trend is in gold or silver or anything that I'm looking at, really. And then I start kind of honing things down a little bit. I'll go from a weekly chart down to a daily chart, and then from a daily chart down to like a 30-minute chart. I usually don't get much smaller than a 30-minute chart. But I do like to see if the long-term trend, intermediate-term trend, and the short-term trend are all working together. When they're not, that's when it's kind of difficult to trade things a little bit. Now, there are ways around that. As Richard was pointing out earlier, you don't want to pound at the market all day long. You can find some intraday swing type moves, not in and out in 5 or 10 minutes, but something you can get into in the morning and ride it up until the middle of the afternoon or something like that, though it's still a day trade. But you can get into that, and I'll show you a little bit about that a little bit later. But I like to, if I can, I like to literally swing trade things. I like to get into gold and hold it for 2, 3, 4, 5 days, weeks, months, whatever I can do, and whatever the market allows me to do. I mean, there's nothing less that I'd love to just buy something and hold it on to it for 12 years. But will the market allow you to do that? And that's the one thing that we have to kind of beware of. So, but I do like to put some simple moving averages on there. I like a 65-week average, which is a very long-term average. If you think about it, there's 52 weeks in a year. But I like looking at a 65-week average. And then on a daily, I like to look at a 3-day and a 21-day. Now, I'll use the 3/21/65 on a weekly chart. And I'll use a 3/21/65 on a daily chart, just so I don't have to move my stuff around all the time. So when you look at a weekly chart of gold, now the red line that you see here is a 3-period average. So since this is a weekly chart, that's a 3-week average. The blue line is your 21-period average, or this is a 21-week average. And this orange line is the 65-week average. Gold has a tendency to play with the 65-week average really, really well. It'll test it. It'll ride on it. It'll bounce off of it. It'll have a hard time getting through it on a longer term basis. And when I look at a weekly chart, when we're looking at averages, I need to have at least a week or two closing above or below the average to say, hey, we've kind of broken it. Now, if it dips below it during the week and pops back up, doesn't mean a whole lot. So just beware of that. But this is what it looks like. And this is taken yesterday when I was kind of building this thing. So I don't have today's in here, but being on a weekly, probably is not going to show you much of today anyway. But this is the chart that I like looking at just because I can see what the trend is. I mean, right now we're up pretty strong. And if you think about it, I mean, as long as it stays above that 65-week average on a long-term basis, it's bullish. And that 65-week average is down about 1,600. So this thing drops. It could go down to 1,700 to 1,600 and still be in a longer-term uptrend. It's just that it's run so far so fast. I mean, you look at just from the beginning of June, which we were right around the 1,700 area, and it ran to 2,063. It's a pretty good push. So for them to correct this thing back is not going to be too surprising. One thing that's really interesting, though, if you want to kind of do a little research, if you go back into the big gold runs back in the 30s, just 1930s, in the 1930s, 20s, 30s, there was a big, huge run there. Gold just went through the roof. And then you had another big run that was between 2000 and 12, 11 in there somewhere. Of course, it kind of dipped off with everything else during the financial crisis. But you had a big run there. So if you kind of compare those two big runs to what this is doing here, you might be impressed to say, hey, can gold really go, if it performed as those did? I mean, think about it. We went from, what was it, $275 up to right around 1,600 in the 2000 to 2010 time period. If we get that same percentage move, this thing could go up to 5,000, 6,000 easy, if they want to push it that way. So it's kind of interesting. But with the global problems and money problems that we have right now, and our dollar getting kind of liquidated more and more and more, because they keep printing more and more dollars. It wouldn't surprise me that we don't see gold continuing to move up. And even going over to silver, if it's going to outperform gold, well, silver has a whole lot more room to move than probably gold does. But anyway, so going to the daily chart, and this is where I look at the red and the blue a little more with the 321. But notice the 65-day average it's still holding above that even. But right now we've had this pullback, and now they're kind of flip-flopping around that 21-day average. So longer term or swing trading is kind of, is this thing going to go up or is this thing going to break down? That's what we don't know. And that's what I'm kind of waiting on right now, is just to kind of see which way this is going to break. Now, silver, basically the same way. And you'll notice silver just went almost straight up here. It was down, and you'll notice back in February down at $11 or $12. It's run basically to $30. So it's just taken off and shot straight up. It's been a lot stronger than gold has. It's a little more erratic, as you can see here, kind of bouncing around and everything like that, last year into this year, but finally has taken off. It can pull all the way back down to $20 or so and still be pretty strong. So like I said, it's shot up, and that's why when something, it's like a rubber band. Once you stretch it out, it's got to snap back. So I wouldn't be surprised if we don't come back to at least $25 to $24 in silver if it wants to kind of pull back some. Of course, that'll pull gold down to somewhere around the 1850, 1845 area if that happens. So, but that's kind of what I'm looking for if it will happen. If they're going to just kind of continue to push these things, silver gets above 30, it'll probably test the 34 to 36 area, with gold probably going up to the 2150 to 2200 range if that happens, if they're going to move together. So, but anyway, weekly chart, as you can see, is quite bullish. Go to a daily chart and it looks kind of like gold's weekly chart, right? So it kind of smooths things out a little bit, but notice they're holding that 21 period average pretty well. And until we start breaking below that, they've tested it, as you can see, then we're still on the positive side of things here. So it's actually holding up better than gold is, even though gold's corrected back a little bit. So I'm more into the, trading shorter term than longer term until they can start proving themselves to go one way or the other. But anyway, there's that. So key numbers. These numbers it doesn't matter what's in front, and that's that bottom line down there. And the reason why I say that, doesn't matter if it's 17, 20, 18, 20, 19, 20, 20, 20, doesn't matter. Gold has a tendency when it gets to these prices to stall out, have a hard time with it, bump its head. Even on the way down, it does the same thing, bounces off of it. But the 20 to 30 range is kind of difficult for gold. 45 to 50 is. 65, it gets hung on it a little bit. Notice that's real close to the 70 to 75. So you might almost argue 65 to 75. But what's really interesting, it has a tendency of holding 70, but on the way up, it has a hard time getting through 65. So that's why I kind of stuck that in there. And of course, right before the century mark, between 90 and the century mark, is going to have a little difficulty also, up or down. So these work to the upside or to the downside on the way down. And so I'm always keeping my eye on these ranges, if you will, to see where we're trading at that time. So I'll look at the current price. I know where the ranges are. Where are we trading based off of that? And what trend are we in? Is it moving down? Okay, if we get below 30, it's probably going to test the century mark or the 20, and then below there, the century mark. If we're moving up, if we get above 50, we're probably going to 65 to 70. That's just kind of the way I look at it. So, but there's different ways of trading it as opposed to just looking at these numbers and saying, well, what do you do with them? Well, and that's exactly what we're going to kind of look at a little bit here. Now, notice this, and I pop this in here for a reason. And this kind of displays things really, really well. This is a daily chart of gold. Notice when it ran up here, it went to 2089, just right there at 90, okay? And then it yanked back, and look where it came back to, right here to 1890. And so we start moving back up and get stuck in this 20 to 30 range, all right, on that bar. And right now we're coming up to the century mark on this bar. So it plays with those. Even look down here at this low, 1690 came down and bounced off that 90 and zipped right back up again. And you'll notice this little high right in here is right around 75. So it likes to hit those prices, and that's what I've been noticing over time, is what it likes to kind of migrate to. So if I know if we're coming up to that 65, 70 area, don't try to buy it then, wait till it breaks out of that and then try to buy it. And, or if it's coming down, I know it's going to hold support there. And if it does, cool, then we'll go from there. So when we start looking at trading gold, and I'm going to look at the shorter term here, there are two ways I use the numbers, as I was just discussing. One is a breakout move, and one is what I call value, which it pulls back, it holds support, you buy it there and bounces back up, all right? So everybody likes to buy on value because you get a better price. You don't have as much risk that way. And that's exactly kind of what we're looking at here. So I want it to either break above or below the ranges, or I want it to hold support or resistance at those ranges. And that's the thing that when I start watching how it's dancing, if you will, I want to see what it's doing with that range. Is it just going to plow through it and go? Or is it just going to go up there and hang out and roll back over? And that's where the value move or the breakout move kind of comes in. Now, this was yesterday's market. Notice here that they came down to this 70 area. Ta-da. And you notice overnight, actually this is the previous day, this is like Monday, and then we opened up in Globex. Now, I didn't tell you the trading hours. Gold opens up at 5 p.m. Central Time, and it closes out at 4 p.m. Central Time the next day. That is 1 day's trade, all right? Just because across the international date line, it's tomorrow over there, when it's today here, all right? So they look at the 24-hour market, all right? So gold trades throughout the Asian markets, the European markets, our markets, and then closes out, and then we start all over again. So when it started out yesterday, well, actually day before yesterday in the evening at 5, it started kind of pulling up here. Now, it had a hard time getting through that 75 area, and finally it broke out of it. Now, breakout point here. just because it pops its little head above that little 5-point range doesn't mean I'm just going to jump on it and buy it. All right. It's got to prove to me that it's going to go. So when I start looking at something breaking out, I want it to prove it's going to continue to break out, as opposed to going, I mean, how many times you've seen it, you jump in there, you get long, and it sells right back off just because you were a little bit early. Though your analysis might be right, you were just a little too early getting in. And that's what we want to avoid. So when I start looking at the breakout, I'm going to give it some room. Instead of going 1 point above the range at 76 in this point, right? I'm going to give it about 6 points. So I'm going to get in at 81 as opposed to 76, because if you can get to 81, it's definitely beyond the range and it's probably going to continue to go. And you'll notice once it got to 81, it never looked back and it shot straight up. And then it got stuck between 90 and 2000. And it just chewed through that. And then, of course, it broke back below 90, and look where it went, right back down to that 70 to 75 area, right back in that same little range that we were looking at earlier in the evening. So when I look at the breakout, I got to give it some more room. Now, this is holding the range, and this is the same chart. Notice they got up into that range and started chewing around. So the longer it stays there and doesn't break out of this range, the more likely it's going to reverse. And notice, this is a 30-minute chart. You had hours here that it just could not get above 2000. It poked its little head up to 2001. But remember, breakout, I'm going to give it about 6 points. It's got to get to 2006 before I'm convinced. So it's chewing and it's chewing. And finally, it just said, can't do it. And it flipped back around and sold right back off again. Got back into this little comfy zone down here between 70 and 75. And then it starts to bounce and it kind of bounced back up to almost 90 in here. But that's the thing. I want to see if it's holding that range or if it's breaking out of that range. In this case, that's the hold. So in the breakout, I want to give it about 6 points above or below the range. So those ranges that we were looking at, and this is what I was telling you earlier, you could have bought it at 76, taking a little heat. But like I said, 1 point doesn't make a market. So I'd look to buy it at 81, 6 points above that range. And then look for a target in the next range. So if you got up to 90 to 2000, I'd see if it was going to break through that and let it chew, let it chew, let it chew. And if it's not, then well, okay, we'll go from there. Now, when you enter at 81, your stop's got to go below 70. So you got to risk about 12 points on the thing at least. So you got to have to give it some room around those ranges. Now, once it got up in that 90 to 2000 range, if it wasn't breaking through, I'd probably scrunch my stop up to 89, just below that 90 and say, if you can't break, just get me out. So that's about an 8-point move from 81 to 89, right? So that's $800 in gold. That's not a bad little move there. But that's one thing that I'm always looking at is what is it going to do with that next range? Now, here it is again. So we buy it at 81. It moves up to the next range and chews around. And at that point, you'll notice they couldn't break below 90 here, slapped the stop at 89. And once it broke that, look what it did, went all the way back down. So initially, you got about a 12-point risk. But once they get to that next range, I immediately start moving my stop up and saying, okay, break the next range. If you don't, get me out. And that's exactly what it would have done here. Now, on the other side of that is, does it hold the range? In other words, does it fail to break? All right, which is what we were seeing, right? It was just could not get through that 90 to 2000 area. So if it's going to fail, then I'm willing to take a little more, I guess risk is the best way of putting it, because I'll use about a point outside of that range. So I'd sell the thing at 89 if it broke below 90, because it wasn't breaking below 90 and it wasn't really getting above 2000. It didn't break above the range, but it was holding the range. So I'd put in a sell at 89, which is where my protective stop was, right? And usually when if they're holding the range and they can't get through it, they'll push a lot faster and a lot easier. So in this case, I was looking at that, holding the range, sell it at 89 and see if it goes back down and test that 70 to 75 area. And again, working the exact same way, will it break below 70? If it doesn't, then I have to scrunch my stop up to down to 76 and say, get me out or break. And of course, it didn't do that. So when you're looking at gold, you have to kind of watch it a little bit, especially if it's between the ranges. And we'll go over to a live chart here in just a minute. But I want to see if it's going to hold that, all right, or if it's going to break that. In fact, let's just do that now. Let's go check out gold. Bing. Here we go. Here's a chart of gold. Bing. This is a 30-minute chart. We'll scrunch things up a little bit here so we can see everything. There we go. So this morning, notice here, they were bouncing between this 75, 65 area, right? And they finally got below 65 and they came down. We're trading at 45 right now. There's that 45 number. So we got 45 to 50. So if they can break below this 39, then we'll probably go down and test that 20 to 30 range. Question is, are they going to hold in here? If they do, then we might see if we can't get in around 51 or so and see if they'll kind of push back up to that 65-ish range. But we're in a downtrend right now. So I would prefer to sell the thing at 39 and see if it goes down and test that 20 to 30 range, just because that's the trend. Trend is your friend, right? So, but that's what we're going to have to watch for here, is to see if they hold this or are they going to break this. So it's got a nice little comfy spot. It's right around that one of the little key numbers. So once it gets below 40, it ought to take off, because the break, 6 points, hold 1 point, right? So I got to see 39 to convince me that they're going to break below this 45 area. But every day I've got to come in here and say, okay, where are we trading now based off of my little numbers? All right. Now, if you don't want to trade gold, of course, you can trade GDX or GDXJ or any of the GLD or anything like that. Buy options on them, however you want to do it. But that's the one thing I'm always looking for, is to see where we're currently trading based off my little ranges. Doesn't matter what's in front of it. Right now we're at 1945 instead of 2045 or 1845. And then start figuring out, they holding or are they going to break? And sometimes you got to sit on your hands, and sometimes the thing won't move all day long. Sometimes it'll get stuck in one of those little ranges and just chew all day long and won't go anywhere. So you have to be prepared for that, or go look for something else. And it might be a good day to go sell puts or sell calls on GLD or GDXJ or whatever it may be, and take in the premium off them as it's just chewing around. I have done that too, just because I got to trade something, right? So I got that blood in me. So I got to trade something. So I might just go over to the options market and sell some premium and let that decay out. It's best if you find a stock that has weekly options, of course. You can get that decay a whole lot faster. So, but watch how that holds and plays in those little ranges. Let's go back over to there. Okay. Now, hold range. This is what we were talking about. There's that same chart, broke that range, finally sell the thing at 89, and look, it just never turned around and looked back until we hit that little range down at the bottom before it kind of bounced up a little bit. So now silver, and here's GDXJ. I forgot to put that in there. You'll notice on that same move, go back up here, on gold moving down. Now, let me explain this chart real quickly. I'm sure you got a question about that. Why are there blue bars and why are there green bars and red bars? Blue bars, go back to the 24-hour market here just a little bit. At the beginning of each of the global markets, we have a new open or a new influence in the market, all right? So in our evening time here in the United States, when we're getting off work, going to eat supper, taking kids to soccer practice, whatever it may be, that's when the Asian markets are opening up. So it's tomorrow over there. It's nice early in the morning, and boom, their little ding, ding, ding goes off, and their stocks are open and trading while we're eating dinner and watching Forged in Fire on TV, whatever. So This blue bar at the far left here is the beginning of the Asian markets. All right. This is what we call reference bar number 1. That's for the Asian markets. Then you get to the European markets. Asia closes out at 3 o'clock in the morning. They're gone. Europe is now in control. So this time period between that's 3:30 in the morning, basically, up until 8:30 in the morning is the European controlled market. Then we get to our ding, ding, ding here in the United States, and we have our open. And that's what that blue bar is. And there's actually one more, because we actually have 2 different markets here in the United States. You have an East Coast market and you have a West Coast market. I mean, think about it. At 1 o'clock in the afternoon Central Time, 2 o'clock Eastern. What are you thinking about at 2 o'clock in the afternoon if you're at work? When I get off work, I need to run by the store and grab some steaks for dinner or whatever. And when we're going to get home, we'll eat and everything like that. And then we're going to go over to grandma and grandpa's house and talk with them a little bit and blah, blah, blah. Got to get home, got to get to bed, got to get the kids to school. That's what your brain's going through. Well, over on the West Coast, they just finished their first bagel and they're ready to rock and roll. So in the afternoon market, you got a West Coast market. In the morning, you have an East Coast market. I mean, think about it. Ding, ding, ding. That's 6:30 in the morning over there. That's people just waking up when the market's opening up. And so you get a different influence in the market. So at 12:30, we'll get another blue bar. This is all in Central Time. So we divide the market up into 4 separate time segments: Asia, Europe, morning US, afternoon US. So the horizontal blue line you see right there is the open of the most current reference bar. So I know where that open is. And you'll notice they like to hold that open. You'll notice the market likes to hold opens. It closes, it doesn't really care about all that much. An open, it does. You look at year opens, month opens, week opens, it likes to hold those. Just watch the 8:30 open, the ding, 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 and watch how stocks just bounce or can't get through that open. You'll see that a lot. So that's what this is doing. Then you've got some buy zones and sell zones on this thing. This is what we call a compass chart out of our software. And it tells you when something gets into a buy or it's a confirmed buy. You'll see a red arrow. See that red arrow? That's because this blue bar went into that sell zone, and then the next bar surpassed the first one that penetrated into that sell zone. So it was telling you, get short. And of course it went down. So that's what this chart is showing you. Now, go back to here. And that's what this is. This is the open at 8:30 because stocks don't trade 24 hours. Some do if you use TD Ameritrade. But again, you have the horizontal blue line, which they were holding here somewhere around 61.5 on GDXJ. And it did exactly what gold did. It broke down, got a confirmed sell, and it actually went down to its target and then kind of started hanging out. So you can trade this based off of what gold is doing. If gold hits 89, as we were looking at, you could short this or buy puts on it. And when gold got down to that 70, 75 area, you cover it. And granted, it's only about a $2 move here, but that's not bad. You can pick up some money out of that, no problem at all. Another thing that you can do is you can trade silver along with gold. Same thing. It was doing a little better. It wasn't chewing as bad as gold. Here's their open. That was at 5 o'clock, and it took off. But it still was kind of trying to push up a little bit here. And of course, gold just wouldn't let it go. And finally, they just had to pull this thing back. But notice it didn't come back as far as gold did. Gold came back down into that 70 area. Of course, this is a silver chart. And notice silver didn't come down as far. It actually wanted to be stronger than gold. So when I see that, I have a hard time shorting this just because silver's been so strong, and you can look at relative moves. I'll say it that way. How silver moves with gold. And I look at relative moves between markets all the time, basically saying this. On average, and let's go over here. Oh, there we go. I'm going to shrink this back up. Think. There. On average, and look at the center chart here, you'll notice you'll have a symbol that says GCZ20, and just below there it says ATR. That's a 14-day average range. All right. So gold moves on average, if you just take a 14-day average, 44 points in a day. Silver, bottom chart, center, moves $1.36 in a day, right? So I'm gonna grab a calculator here. So 1.36. So for every 1 point move in gold, I should get a 3-cent move in silver. That's what I mean by relative moves. I just took the $1.36 and divided it by 44 and said there. I should have a 3-cent move for every 1 point move in gold. So if I see a 10-point move in gold, I should see a 30-cent move in silver, right? And that's exactly what I start looking at. How far did gold move? We went from, what, 63 down to 43. There's 20 cents, right? So, or 20 points. So if I look at 20 points, that should be like a 60-cent move in silver. We opened up on silver at 27.83 and we went down to 27.50-ish. Actually, let's just say 27.40. So I got a 40-cent move in silver. I got a 20-point move in gold. Well, I'm supposed to have a, what, 30-cent move in silver. Silver actually moved down more than gold did. So silver is actually weaker than gold today. See my point? So I start watching those relative moves. Now that's only on a short-term basis. You can't do that over a long-term because markets usually move in percents longer term, as opposed to point moves. That's just a point move. So just beware of that. But anyway, I like to see those relative moves between markets. And are they holding to it? Are they moving in synchronized motion? If they're not, then I have to be cautious. You always want to trade the strongest one moving up and the weakest one moving down. All right. So I'm always wanting to see who's wanting to be the strong arm of the law or who wants to be the weak one. And you'll notice that just looking at the chart here, the top right one is GDXJ. The center right one is SIL. And the very bottom right is actually copper. I threw copper in there because I trade copper too. So, but they're metals, but notice what copper's done. Look at the blue bar. Copper is actually above its blue bar, where everybody else is below that blue bar, except for GDXJ is just inside of it there. But that's the thing. I want to see who's moving with what. Now, copper is a totally different market. It's more of a totally industrial metal, the red metal. But it's a good indicator, I'll say it that way, of global economics. If it's moving up, the global economy is strengthening. If it's going down, the global economy is weakening. So it's a really good economic indicator, in my opinion. It's had a nice little rally. I don't know if you care to see it, but here, ding, there's copper. It's had a nice little rally, which is telling you that the global economies are actually strengthening up, and maybe getting out of this COVID stuff, who knows? But it's kind of a leading indicator. But it's also kind of a good leading indicator for looking at gold and silver. A lot of times it'll start moving before gold and silver will start moving. So I always kind of keep my eyeball on it. Or you can watch, what is that, Freeport McMoran, FCX? That's a good copper stock. It'll move right along with copper. You can overlay the charts and it moves right along with it. So that's the one thing that I'm always looking at, is to see if those things are moving in synchronized motion. And back to here. And of course, here's SIL. This is off of yesterday, and it kind of moves right along with that. But that's basically how I'm looking at trading gold intraday, if you will. I want to see if it's holding the range or breaking the range. And I use those ranges every day, all day long, just because they work so well. So, and there are times that, you know, you're going to get hung in a trade. Don't get me wrong. Nothing's ever 100%. News will pop out. It'll reverse the market. I mean, especially in this day and age, you got a lot of, you know, higher ups flapping their gums around somewhere. So a lot of times it'll reverse and take off, or it'll really dump off when you're long. You're like, what's going on here? And you get to find out that, you know, somebody said something somewhere. But you do have to be aware of that. But do watch those ranges. They work really, really, really well, in my opinion anyway. So I guess I'll roll into this real quickly. I have a trade service. It's called Trade of the Day. And it's a swing trading. It's not day trading. It's swing trading. I prefer to swing trade on a longer term basis, as I mentioned earlier. Each day, I'll look for a specific stock or a futures contract. When the futures are just kind of chewing around, equities a lot of times better. Sometimes you can't find anything in equities, so I run over into the commodity markets or whatever and find that. Sometimes I'll put 2 trades out in a day. I'll usually put 1 trade out. Sometimes you can't find anything, and you just say, leave it alone. So, but I'll look for support and resistance in those markets. I'll look for buying and shorting opportunities. And of course, I'll always look for the risk involved. Always try to reduce risk the best I can. So what's included, I'll have my daily stock option commodity trade, or sometimes a stock and a commodity trade. Each day I'll go through and try to pick the highest probability stock option commodity that I can, and I will email it out to you. So I'll also give you a daily market analysis. I will actually make a video that's going to be in the email. You can click the little link and you get to see my pretty face. But you can look at that, listen to it, but I'll go through the equity markets, what they've done throughout the night, because it is a global market, and then start looking at what we're going to be trading through that day and kind of what my thought is on the day or what's happening over the next couple of days or whatever it is. When earnings are around, we'll usually do some earnings plays, and we'll look at what's coming up in earnings and things of that sort. So I'll also give you what I'm looking at for that day, my watch list. And that way you can, I might not be trading all of them. I might just be trading one of them. But those are the ones that I've looked at and thought, I like this. I like that one too. So, but I always try to find the best one out of the bunch to trade that day. That goes out in the email. But I'll give you that list if you want to check them out. A lot of people use those to trade or day trade or whatever it may be. But I'll give you that watch list as well. And of course, I'll give you how my trade works. I never go click on the mouse unless I know where I'm going to enter, where's my risk, my stop, protective stop, and where's my target. I have to have those 3 things before I do anything, and you will get that. I will say this is where I'm entering, this is where my stop is, and this is where my target is. When I hit my target, I'm out. When I hit my stop, I'm out. That way there's no ambiguity. I'm not going to sit there and say, well, I'm going to go ahead and get out. I'll leave them in it. That's not fair, right? So that's what I'll do. Now, if I do think that we need to get out, I will send out another email. Get out of this trade. So otherwise, just keep what's on there. And also have a trade sheet. It's a Google Doc, put it that way, that you'll have access to. It has all the trades on there and everything. So where's the stop, where's the target, and all that. All right. So, and also I have a monthly review session. Usually the 3rd Friday, options expiration day of every month, I'll do it. Sometimes I get really busy and I can't do it that day, and I'll push it to the next week or something like that. But I do try to do a monthly review session, just to say, this is what we've done. This is what I'm looking for. Do you have any questions? And if you do, great. Those sessions will run anywhere between 10 minutes and 45 minutes. Just all depends on the questions and my answers. I can get kind of long-winded on answers sometimes. So, but anyway, we do that, get together live as opposed to just seeing me in a video or whatever it is. So, and of course, this is what you get in there: the daily stock and option trade, the daily analysis, the watch list, trade management alerts, and of course the monthly review session. And this is just a little testimonial I chunked in here from a gentleman. The one thing you'll find out, I'm kind of black and white. I think if I wasn't married, that my house would be black and white. Good thing I have a wife, right? So, but a lot of times you might send me an email saying, hey, do you like this? I might just reply, yes. There's my answer. I don't do it to be mean or anything like that. It's just sometimes I just get real basic. But I don't do a lot of hype, and I don't do a lot of anything. I just say, this is what the market is. This is how I think it's going to work. If it does, great. If it doesn't, well, we'll come back and try it again. So, but anyway, And if you do sign up on Friday, this Friday at 10 a.m. in the morning, we'll do a little kickoff session, get together and we'll discuss things a little bit, see what's going to be happening coming up, and kind of go through how I analyze the market and how I go through the market and how I find the stocks and stuff like that I do. So, and if you want to do that, you can do this for a price of $97 for a year. That means you'll be getting somewhere around 200 trades throughout the year, analysis, all of the management alerts, the monthly review sessions, all that for a whopping price of $97. You think about that, that's less than a can of Coke a day. So the link is right there, dtitrader.com/tgas. If you want to do that, or of course you can call here at 904-416-1776. Raleigh? I think I'm done, unless we got questions.
Yeah, Geof. Hey, great. Thank you so much for that presentation. And it's great to see you. It's been a while since.
It has been a while.
It's been way too long, but anyway, great presentation. Really enjoyed that. Very, very straightforward. Some questions came in and I made some notes on those. A lot of people seem to ask, very interested in, are those simple or exponential moving averages that you use?
Simple. Simple.
Okay.
Like I said, I'm a simple person.
Okay. I would have guessed that, as opposed to Geof, he's quite exponential, if you know what I mean.
Mm-hmm.
Another person asked the question, why do you use the 65-week average?
Good point. It was not my idea. How's that?
Okay.
I have no problem with borrowing stuff at all. There are two women, the Aiden sisters, Pamela and Marianne Aiden. They have actually a newsletter called the Aiden Forecast. I've been reading it for 25 years. They are long-term people. They don't do anything short-term or swing trade, nothing. They are very, very long-term people. And I noticed that in their newsletter, in fact, hold on, give me a second here. Here we go. Newsletter. They actually use a 65-week average. And so I started watching that, saying, really, that's really long-term. And lo and behold, I noticed that a lot of the commodities and stuff, even stocks, will hold that 65-week average. So I actually borrowed it from them. And I have used it ever since and love it. It's like it's not a black box by any means, but it gives you a really good idea on a long-term basis how something is performing.
Oh, that's great. And so once again, that's something that somebody else had worked with. You brought it into your own system. You looked at it and you said, by gosh, this works.
It does. And in fact, the 321 average, just to kind of build on that a little bit,
Sure.
There was a money manager that I met who was out of Honolulu, and he actually used the 321 on a daily, but he used it with a Bollinger Band. But I started watching that 321 just because he mentioned it to me. And what he was doing is he would let the 3 cross the 21 and go across the mean line in the Bollinger Band, and his target would be the upper deviation.
Okay.
I was like, that's pretty cool. And I started watching it, and stocks actually do that really well on a daily basis. So I thought, well, I can put the 321 and 65 on here and just see how it works, and it worked great.
Oh, that's fantastic.
So I stole it all. How's that?
Well, yeah, you know, it's not what we steal, it's how we apply it.
Mm-hmm. That's right.
But along those same lines, some questions have come up about, are there any other, indicators you use? Like, for example, do you use the stochastic or the RSI to detect potential reversals?
No, well, I'll say it this way. What I showed you here is exactly what I use. I don't.
That's
use
your
anything
chart,
else.
right? Yeah.
I got my chart. I got my key numbers. I'm a tape reader. I like looking at prices, the old ticker tape, except we got electronic now. But I like to look at those prices, and I like to look at those charts. And if I can find the trade out of there, then I'm good. But I don't use anything else.
Okay. Well stated. Well said. And once again, I know from past presentations with you, the software that you guys have developed has been developed over years. I don't even want to think about the hundreds of thousands of hours that have gone into that.
Yeah.
But what else do you need? Something else question came in here. Why and how do you use the Tuesday 9:30 a.m. number?
Well, that's more of what's the best way of putting that? It's a very good indication. If you look at the open on Sunday night and you look at the 9:30 number on Tuesday, that's the first hour of the market on Tuesday. If you're above that range, those two opens, if you will, odds are that stock, commodity, whatever, is going to be up that week. If you're below that range, odds are it'll be down that week. And it doesn't tell you how it's going to get there, okay? But it's a really good, it's about 70 to 75% accurate of saying this is going to be up this week or this is going to be down this week. So it's just one of those mental things saying, hey, we're above that range. Hey, but this thing ought to be kind of moving up here this week.
Outstanding. And look, once again, looking at the questions. Now, these aren't so much questions, but Geof, I got to pump your ego a little bit. You've got several people in here that are students and followers, and they all attest to the fact that you are one awesome teacher. And I think sometimes, the frankness that you have is well appreciated these days.
Well,
several people walk in and say, what does TGAS stand for? Is that an acronym?
Well, actually, my initials are GAS, Jeffrey Allen Smith.
There you go.
And the T, trading with gas. So
there you go. Sometimes, what the heck is going on here? Every now and then I must say something and Siri starts talking to me. Let me just turn that damn thing off. Hey, Geof, listen, final question, and kind of in keeping with the theme of what we're doing here in Trade the Moment. Are there any things in the current market environment and with the election coming up that give you pause, that you might be concerned about, or that you're paying specific attention to as you look at the markets?
Well, the problem that we have, and this is the one thing that, I always do what the market tells me to, as opposed to me telling the market what to do, because nobody can ever do that.
Wise words.
And the thing is, as long as the market is going up, then by all means, you got to be long there. I'm not worried about the market until it tells me to be worried. The one thing that gives me pause, I'll say that, as you were asking, is that you've had the NASDAQ making new year and all-time highs. You've got the S&P making new year and all-time highs.
Right.
Until today, the Dow has yet to be above its year open. So, which tells me the Dow's still weak. And not only that, the Russell's still down 5%. So if everything's doing so great, why is the Dow and the Russell hurting here?
Mm-hmm.
And because markets usually move together.
Those four in particular, yeah.
Yeah. And so what gives me pause is why are those two doing that? So I am a little cautious until, in the Dow, like I said, the Dow got above its year open today, and I was just like, well, praise the Lord, finally, I got some agreement here, but I look over at the Russell and it's down 5.6% still. And I'm just like, come on, get moving. But if we can get all of those above the year open, we'll have a much stronger market. Until that happens, I think you're going to see it clawing to go higher. But once the election happens, that's going to be a really interesting. In fact, if you want to see a crazy wild market, watch the S&P futures on election night. It will go all over the place.
So as the results are coming in and people are trying to just deal with stuff, et cetera, outstanding. Exactly. Well, Geof, listen, thank you so much for your time today, for your presentation, the preparation that you put into it. And I can attest to what others had to say. You are a first-class teacher. You've been around the horn. You've got a great service there. And folks, once again, Geof Smith here with Diversified Trading Institute. His special offer for the trade of the day, daily stock option and commodity trades, the daily market analysis and the watch list, trade management alerts, monthly review sessions, and more. I just have 3 bullets here to use, and those were the key ones. But anyway, he's a terrific guy, and he has an awful lot of value, a lot of followers, and dtitrader.com/tgas is that special offer. So once again, Geof, thank you so very much for your time today.
Well, thanks for having me, and enjoyed it. And even got to see a pretty face.
You're not talking about me?
He's kind of cute, isn't he?
Yeah, I was going to say, well, damn, I'm blushing here.
I'm going to come see you, Geof.
Okay, I'm waiting.
He's waiting.